Discuss the taxability of dealing in shares of stock listed and traded in the stock exchange. Every sale, barter, exchange, or other disposition of shares of stock listed through a local stock exchange, other than the sale of a dealer in securities, shall be subject to 1. Stock transaction tax of 1/2%. Number 2. Based on the gross selling price or gross value in money of the shares. Note, if the sale is made by a dealer in securities, the resulting gain or loss is considered as ordinary gain subject to graduated rates, 20% to 35% for individual, and normal corporate income tax of 30% for corporations, Section 127. The term dealer in securities means a merchant of stocks or securities, whether an individual, partnership, or corporation with an established place of business, regularly engaged in the purchase of securities and the resale thereof to customers, that is, one who, as a merchant, buys securities and resells them to customers with a view to the gains and profits that may be derived therefrom. Section 22. Passive investment income. Passive incomes are earned with very minimal or even without active involvement of the taxpayer in the earning process. What is the tax treatment of passive income? Passive income may be subject to schedular rates, example, dividend income received by domestic corporation from a non-resident foreign corporation, under Section 28, letter B, number 1 of the NIRC. Number 2, subject to final tax, example, interest income from foreign currency bank deposits by a resident citizen under Section 24. What are the sources of passive income subject to final tax? The following are the sources of passive income subject to final tax. 1. Dividends. 2. Royalties. 3. Interest. And 4. Prizes, awards, and winnings. Note, they are not added to other income in the determination of ordinary income tax liability, Section 24. Define dividend income. It refers to any distribution made by a corporation to its shareholders out of its earnings or profits and payable to its shareholders, whether in money or other property. Section 73, letter A. When is dividend income subject to tax? Dividend income is taxable at the time of their declaration by the corporation and not at the time of actual payment of dividends, since dividend income is taxable whether actually or constructively received. Are stock dividends taxable? The general rule is that stock dividends are not taxable. Applying the severance test exception, cancellation or redemption of shares of stock issued as dividends, the amount distributed in redemption or cancellation shall be considered taxable income. Section 73. Note, for the exempting clause to apply, it is indispensable that 1. There is redemption or cancellation. 2. The transaction involves stock dividends. And 3. The time and manner of the transaction makes it essentially equivalent to a distribution of taxable dividends. Of these, the most important is the third, Commissioner of Internal Revenue versus Court of Appeals. Does reclassification or exchange of shares give rise to a taxable event? No. Neither the reclassification nor exchange per se yields realized income for tax purposes. The exchange of shares without more produces no realized income to the subscriber. There is only a modification of the subscriber's right and privileges, which is not a flow of wealth for tax purposes. Discuss how dividends received from a domestic corporation is taxed. The final tax on dividend received is fixed at 1. 10% cash and or property dividends actually or constructively received by citizens and resident aliens, including the share of an individual, and the distributable net income after tax of a taxable partnership of which he is a partner. Section 24, letter B, number 2. Number 2, 20% cash and or property dividends actually or constructively received by non-resident aliens engaged in trade or business, including the share of an individual in the distributable net income after tax of a taxable partnership of which he is a partner. Section 25, letter A, number 2. Number 3, 25% cash and or property dividends actually or constructively received by non-resident aliens not engaged in trade or business, Section 25, paragraph B. 4. Exempt, received by domestic and resident foreign corporation in intercorporate dividends. 5. 15% received by non-resident foreign corporation provided that the country in which the non-resident foreign corporation is domiciled shall allow a credit against the tax due from the non-resident foreign corporation taxes deemed to have been paid in the Philippines equivalent to 15%, which represents the difference between the regular income tax of 30% and the 15% tax on dividends. Tax sparing rule, Section 28, letter B, number 5, letter B. Note, a principal defect of the tax credit system is when low tax rates or special tax concessions are granted in a country for the obvious reason of encouraging foreign investment. For instance, if the usual tax rate is 35% but the concession rate accrues to the country of the investor rather than to the investor himself, to obviate this, a tax sparing provision may be stipulated. With tax sparing, taxes exempted or reduced are considered as having been fully paid. CAR versus Procter & Gamble, Philippines. Discuss how dividends received from a foreign corporation is taxed. If dividends declared by a foreign corporation are received by a resident citizen and domestic corporation, it is subject to regular income tax and normal corporate income tax, respectively. If such dividends are received by a non-resident citizen, alien, and foreign corporation, it is not subject to tax, since only resident citizens and domestic corporations are subject to tax on income derived from sources within and without the Philippines. Note, dividends received from a foreign corporation are considered as derived from sources within the Philippines if at least 50% of the gross income of such foreign corporation for the 3-year period ending with the close of its taxable year preceding the declaration of such dividends, or for such part of such period as the corporation has been in existence, was derived from sources within the Philippines. Section 42, letter A, number 2B. Goodyear Philippines. Goodyear increased its authorized capital stock from 400 million divided to 4 million shares with par value of 100 pesos to 1.73 billion divided to 4 million common shares and 13.3 million preferred shares with par value at 100 peso each. Consequently, all the preferred shares were subscribed by Goodyear Tire and Rubber Company, GTRC, a foreign company registered in the U.S. Thereafter, Goodyear's board of directors authorized the redemption of GTRC's 3.72 million worth of preferred shares at the redemption price of 372 million, representing the aggregate par value, and 97 million, representing accrued and unpaid dividends. Is the gain derived by GTRC subject to 15% final withholding tax on dividends? No. The term dividends means any distribution made by a corporation to its shareholders out of its earnings or profits and payable to its shareholders, whether in one or in other property. In light of the foregoing, the court holds, therefore, that the redemption price representing the amount of 97,732,314 received by GTRC could not be treated as accumulated dividends in arrears that could be subjected to 15% final withholding tax. Verily, respondents AFS covering the years 2003 to 2009 showed that it did not have unrestricted return earnings and in fact operated in a position of deficit. Thus, absent the availability of unrestricted return earnings, the board of directors of respondent had no power to issue dividends. Commissioner of Internal Revenue versus Goodyear. What are disguised dividends in income taxation? Disguised dividends are those income payments made by a domestic corporation which is a subsidiary or a non-resident foreign corporation to the latter, ostensibly for services rendered by the latter to the former, but which payments are disproportionately larger than the actual value of the services rendered. In such case, the amount over and above the true value of the service rendered shall be treated as a dividend and shall be subjected to the corresponding tax of 30% on Philippines-sourced gross income, or such other preferential rate as may be provided under a corresponding tax treaty. An example is royalty payments under a corresponding licensing agreement. Define royalty income. It is the payment for the use and exhaustion of property, such as earnings from copyrights, patents, trademarks, formulas, and natural resources under lease. It covers both payments made, 1. Under license, and 2. Compensation, which a person would be obliged to pay for fraudulently copying or infringing the right. Note: royalties must be derived from sources within the Philippines to be considered as passive income. Section 42. What is the tax treatment of royalty income? Royalty income derived from the sale of royalty on a regular basis for consideration is considered as an active business income subject to the normal corporate income tax. When a person pays royalty to another for the use of his intellectual property, such royalty is passive income of the owner thereof, subject to final tax. What are the tax rates imposed on royalty income subject to final tax? Royalty income subject to final tax is taxed as follows. 1. General, 20%. 2. Derived from books, other literary works, or musical composition, 10%. Section 24 to 25. Note: in all instances above, for non-resident alien not engaged in business, rate is 25%, while for domestic and resident foreign corporation, rate is 20% and 30% for non-resident foreign corporation. Sections 27 to 28. What are the conditions for interest income to be treated as passive income? Interest income must be 1. Derived from sources within the Philippines. 2. Earned by an individual citizen, resident alien individual, or non-resident alien individual engaged in trade or business in the Philippines, or earned by a domestic corporation or resident foreign corporation. And 3. Derived from any currency, bank deposit, and yield, or any other monetary benefit from deposit substitutes and from trust funds and similar arrangements. What are the different tax treatments of interest income? Interest income derived from sources within the Philippines may be subject to final tax or exempt. Interest income derived from sources without the Philippines are subject to a graduated rate for resident citizens or normal corporate income tax rate for domestic corporations. Note: to determine if interest income is income within or income without, determine first the residence of the debtor. Source is within if debtor is a resident of the Philippines. Section 42, letter A. How is the tax on interest income subject to final tax determined? Interest income subject to final tax is taxed as follows. 1. From any currency, bank deposit, yield, or any other monetary benefit from deposit substitutes and from trust funds and similar arrangement derived from sources within the Philippines, 20%. 2. From long-term deposits, LTD, or investment in the form of savings, common or individual trust funds, substitutes, investment management accounts, and other investment evidenced by certification in such form prescribed by BSP, exempt. Note: in case of pre-termination before the 5th year, a final tax shall be imposed on the entire income whose holding period was A. 4 years to less than 5 years, 5%. B. 3 to less than 4 years, 12%. C. Less than 3 years, 20%. Number 3. From foreign currency deposit units, except in NRC, non-resident corporation, 7.5%, now 15%. Note: under the Train Law, the rate of final tax on interest income received by a resident individual taxpayer under the expanded foreign currency deposit system increased from 7.5 to 15% final tax. What are deposit substitutes? Under Section 22, letter Y of the NIRC, the term deposit substitute shall mean an alternative form of obtaining funds from the public. The term public means borrowing from 20 or more individual or corporate lenders at any one time, other than deposits, through the issuance, endorsement, or acceptance of debt instruments for the borrower's own account, for the purpose of relending or repurchasing of receivables and other obligations, or financing their own needs or the needs of their agent or dealer. Congress specifically defined public to mean 20 or more individual or corporate lenders at any one time. Hence, the number of lenders is determinative of whether a debt instrument should be considered a deposit substitute and consequently subject to the 20% final withholding tax. Thus, a BIR ruling which states that all government bonds are deposit substitutes regardless of the number of lenders is not valid because it completely disregards the 20 or more lender rule found under Section 22, letter Y of the NIRC, Banco de Oro versus Republic of the Philippines. What is the tax implication if the debt instruments qualify as deposit substitutes? If the bonds are considered deposit substitutes, 20 or more lenders, the interest income is generally subject to the 20% final withholding tax. If the bonds are not considered deposit substitutes, 19 or less lenders, the interest income forms part of gross income and is subject to the regular income tax rate. Banco de Oro, Republic of the Philippines. What are the conditions that should be present to enjoy income tax exemption of interest income derived from long-term deposit, LTD, or investment? The following are the conditions for income tax exemption. 1. The depositor or investor is an individual, citizen, resident or non-resident, or resident alien or non-resident alien engaged in the trade or business in the Philippines and not a corporation. Number 2. The LTD or investment certificate should be under the name of the individual and not under the name of the corporation or the bank or the trust department unit of the bank. 3. The LTD or investment must be in the form of savings, common or individual trust funds, deposit substitutes, investment, management accounts, and other investments evidenced by certificates in such form prescribed by the BSP. Number 4. The LTD or investment must be issued by banks only and not by other financial institutions. 5. The LTD or investments must have a maturity period of not less than 5 years. 6. The LTD or investments must be in denominations of 10,000 and other denominations as may be prescribed by the BSP. 7. Only the interest income from LTD or investment certificates are covered by the income tax exemption. Number 8. Income tax exemptions does not cover any other income such as gains from trading or foreign exchange gain. And 9. The LTD or investments should not be terminated by the investor before the 5th year, otherwise it shall be subjected to the graduated rates of 5%, 12%, or 20% on interest income earning. Does the 20% withholding tax on passive interest income on deposits apply to cooperatives? No. Under the NIRC, interest from any currency bank deposit and yield, or any other monetary benefit from deposit substitutes and from trust funds and similar arrangements is subject to a 20% final withholding tax. Section 24, letter B, number 1. This provision applies only to interest paid by banks and does not cover interest paid by cooperatives. Moreover, members' deposits with the cooperatives are not currency bank deposits nor deposit substitutes. Thus, interest on members' savings and time deposits with duly registered cooperatives are not subject to income and withholding tax. The legislative intent under RA 6938 or the Cooperative Code of the Philippines is to give cooperatives a preferential tax treatment and tax exemption. This tax exemption should be construed to extend to members of cooperatives. Castillo Dumaguete, Cathedral Credit Cooperative versus Commissioner of Internal Revenue, 2010. Define rental income. It refers to the amount or compensation paid for the use or enjoyment of a thing or a right and implies a fixed sum of property amounting to a fixed sum to be paid at a stated time for the use of the property. What is the tax treatment of income received from lease of property? The following is the tax treatment of income received from lease of property. Type of rental income. Rental income on property located in the Philippines paid to taxpayer, resident citizen, non-resident citizen, resident alien, non-resident alien engaged in trade and business. Tax rate, normal graduated income tax rate. Domestic corporation, resident foreign corporation, Section 32, Number 5, Section 42, letter A. Number 4, regular corporate income tax rate. Non-resident alien, not engaged in trade or business, or Section 25, letter B, final withholding tax of 25%. Non-resident foreign corporation, Section 28, letter B, final withholding tax of 30%. Non-resident foreign corporation, gross rentals, lease, and charter fees of foreign vessels, final withholding tax of 4.5%. Non-resident foreign corporation, gross rental, lease, and charter fees of aircraft, machineries, and equipment, Section 28, letter B, final withholding tax of 7.5%. Rental income on property located outside the Philippines paid to resident citizen and domestic corporation, Section 24, letter A, Section 27, letter A, Section 32, number 5, Section 42, letter C, number 4, normal income tax rates. Rental income on property located outside the Philippines paid to non-resident corporation, resident alien, non-resident alien engaged in trade and business, non-resident alien not engaged in trade or business, resident foreign corporation, non-resident foreign corporation not subject to income tax. These are Section 24, letter A, 1, letter B, Section 28, letter A, number 1, Section 32, number 5, and Section 42, letter C, number 4. What is the tax treatment of leasehold improvements made by the lessee? When the lessee erected or built permanent improvements in the leased property, which will become the property of the lessor upon the expiration of the lease contract, the value of the improvements should be reported as income of the lessor. Note, no income accrue to the lessor if the improvements are subject to removal by the lessee. What are the methods of reporting income from improvements made by the lessee? In reporting income from improvements made by the lessee, the lessor may use any of the following methods. Outright method. Income is recognized at the time when such buildings or improvements are completed at fair market value. Number 2, spread out method. The lessor spreads over the life or remaining period of the lease the estimated depreciated value of such buildings or improvements at the termination of the lease and report as income for each year of the lease an aliquot part thereof. This applies when a building is erected by a lessee in the leased premises in the pursuance of an agreement with the lessor that the building becomes the property of the lessor at the end of the lease. What is the tax treatment of advance rental paid by the lessee? Prepaid or advance rental is taxable income to the lessor in the year received, if so received under a claim of right and without restriction as to its use, and regardless of method of accounting employed. Security deposit applied to the rental of the terminal month or period of contract must be recognized as income at the time it is applied. Note, if the security deposit is to ensure contract compliance security deposit with acceleration clause, it is not income to the lessor until the lessee violates any provision of the contract. What is annuity? It refers to the periodic installment payments of income on pension by insurance companies during the life of a person for a guaranteed fixed period of time, whichever is longer, in consideration of capital paid by him. It is paid annually, monthly, or periodically, computed upon the amount paid yearly, but not necessarily for life. Peralta versus Auditor General, GR 8480. What is the tax treatment for the proceeds from annuities or insurance? The portion of the proceeds representing return of premiums paid is not taxable, return of capital, while the portion that represents interest or amounts in excess of premiums paid, return on capital, are taxable. Where the total premium return exceeds the aggregate premiums paid, the excess shall be included in the gross income. What is the meaning of prices and awards for purposes of income taxation? Prices refers to those obtained as a result of effort, while winnings are products of chance of luck. It refers to the amount of money in cash or in kind received by chance or through luck. Prices and awards are generally taxable except if specifically mentioned under the exclusions from the computation of gross income under Section 32, letter B of the NIRC. What prices and winnings are subject to final tax? The following prices and winnings are subject to final tax. 1. Prices derived from sources within the Philippines by an individual amounting to more than 10,000. Such prices are taxed on a per transaction basis. Number 2. Other winnings, except winnings amounting to 10,000 or less from Philippine charity sweepstakes and lotto, which shall be exempt, derived from sources within the Philippines. Number 3. Philippine charity sweepstakes and lotto winnings in excess of 10,000 shall be subject to the 20% final tax. NIRC as amended by Train Law, Section 24, Letter B. What prices and winnings shall be included in gross income to be taxed at regular rates? The following prices and winnings shall be included to determine gross income. 1. Prices derived from sources within the Philippines by an individual amounting to 10,000 or less. Prices and winnings from sources without the Philippines by a resident citizen individual are included in the gross income. In other winnings, there is no threshold amount. Section 24, Letter A. Number 3. Prices and winnings of corporations from whatever source are not subject to final tax but included as part of their gross income. Section 24, Letter B, Number 1. What prices are excluded from gross income? The following are excluded from gross income. 1. Prices and awards made primarily in recognition of religious, charitable, scientific, educational, artistic, literary, or civic achievement, but only if a. The recipient was selected without any action on his part to enter the contest or proceeding, and b. The recipient is not required to render substantial future services as a condition to receiving the prize or award. And number 2. All prizes and awards granted to athletes in local and international sports competition and tournaments, whether held in the Philippines or abroad, and sanctioned by their national sports association. What is pension in general? It refers to an amount of money received in lump sum or on staggered basis in consideration of services rendered given after an individual reaches the age of retirement. What is the tax treatment of pensions? Pensions, retirement benefits, gratuities are generally taxable to the extent of the amount received, except if there is a BR-approved pension plan and the requisites for exemption have been met. Section 32. What is the tax treatment of separation pay? Separation pay may or may not be taxable, depending on the voluntariness or involuntariness of the cause of separation. It is taxable when voluntarily availed of. It shall not be taxable if involuntary. Discuss income from any source whatever. It embraces all income not expressly exempted within the class of taxable income under the law, irrespective of the voluntary or involuntary action of the taxpayer in producing the gains and whether derived from legal or illegal sources. What is the tax treatment of cancellation of forgiveness of indebtedness? The cancellation or forgiveness of indebtedness may amount to a payment of income, a gift, or a capital transaction, depending upon the circumstances. 1. Taxable income. If an individual performs services to a creditor who in consideration thereof cancels the debt to the extent of that amount. Gift. If a creditor merely desires to benefit a creditor and without any consideration therefore cancels the debt, the same need not be included in the latter's income because it is an exclusion under Section 32, Letter B. Capital transaction. If the corporation forgives the debts of its stockholders, which has the effect of an indirect dividend. Is just compensation received from the expropriation of property taxable? Yes. The compensation of income derived from the expropriation of property located in the Philippines is an income from sources within the Philippines and subject to the taxing jurisdiction of the place. The acquisition by the government of private properties through the exercise of the power of eminent domain, said properties being justly compensated, is embraced within the meaning of the term sale or disposition of property. Gutierrez v. Court of Appeals. Are damages received considered taxable income? Damages may or may not be considered taxable income, depending on the nature of damages. Compensation for loss of income and exemplary damages are taxable. Moral damages, reimbursement for hospital bills, return of capital are not taxable. Define bad debts. Bad debts refer to those debts resulting from the worthlessness or deductibility, in whole or in part, of amounts due to taxpayers by others arising from money lent or from uncollectible amounts of income from goods sold or with services rendered. When is the recovery of accounts previously written off taxable? It is taxable when the recovery of bad debts is covered by the tax benefit rule. Otherwise, the recovery is not taxable. Section 34, letter E. Discuss the tax benefit rule. The recovery of bad debts previously allowed as a deduction in the preceding year or years shall be included as part of the taxpayer's gross income in the year of such recovery of the extent of the income tax benefit of said deduction. Define exclusions from gross income. It means income received or earned but is not taxable as income because it is exempted by law or treaty. Rationale. What is the rationale for exclusions? Some receipts are excluded from gross income because 1. They are not income, gain, or profit. Example, life insurance proceeds paid to the heirs or beneficiaries upon the death of the insured and damages received on account of personal injuries or sickness. 2. They represent return of capital. Example, amount received by the insured as a return of premiums. 3. They are subject to another kind of internal revenue tax. Example, gift, bequest, and devices. They are subject to donor's tax and estate tax. Number 4. Their income, gain, or profits which are expressly exempt from income tax under the Constitution, tax treaty, NIRC, or general special law. Example, retirement benefits received under RA 7641, income derived by foreign governments and GSIS, SSS, or other contributions. Who may avail of the exclusions? All kinds of taxpayers, whether citizens or aliens, and whether residents or non-residents may avail of the exclusion. Distinguish exclusions from deductions. The distinctions are the following. Exclusion number 1 referred to the flow of wealth to the taxpayer which is not treated as part of gross income due to its exemption by law or because it does not come within the definition of income. Deductions are the amount which the law allows to be subtracted from gross income in order to arrive at net income. Number 2, exclusions pertain to the computation of gross income. Deductions pertain to the computation of taxable income. And number 3, exclusions are something received or earned by the taxpayer but which do not form part of gross income. Deductions are something spent or paid in earning gross income. Distinguish exclusions from tax credit. Exclusion is an amount received as income or gain of the taxpayer but does not form part of the gross income. Tax credit is an amount representing tax previously paid which may be deducted from the present tax liability to arrive at the tax still due. What are the exclusions from gross income? Under the NIRC. Under the NIRC, the following are excluded from gross income. 1. Proceeds of life insurance policies. 2. Amounts received by insured as return of premium paid. 3. Value of property acquired by gift, bequest, device, or descent. 4. Compensation for injuries or sickness. 5. Income exempt under the tax treaty. 6. Retirement benefits, pensions, gratuities, etc. And 7. Miscellaneous items. Income derived from foreign government. B. Income derived from government or its political subdivisions. C. Prizes and awards. D. Prizes and awards in sports competition. E. 13-month pay and other benefits. F. GSIS, SSS, Medicare, and other contributions. G. Gains from sale of bonds, debentures, or other certificate of indebtedness with a maturity of more than 5 years. H. Gains from redemption of share in mutual funds. Section 32, paragraph B. Proceeds of life insurance policy. What are the conditions for exclusion from gross income of the recipient of life insurance proceeds? The proceeds of life insurance policies must be 1. Paid by reason of the death of the insured. 2. To his heirs or beneficiaries. And 3. Whether in a single sum or otherwise. Note: payments for reasons other than death are subject to tax to the extent of the excess of the premium paid if there are any policy loans, borrowings made on the policy. These are to be considered as advances deductible from the life insurance proceeds received upon death. What is the rationale for the exclusion? They partake more of indemnity or compensation rather than gain to the recipient. Life insurance proceeds serve the same purpose as non-taxable inheritance. What is the tax treatment of interest paid on life insurance proceeds? If the amount of life insurance proceeds is held by the insurer under an agreement to pay interest thereon, the interest payment shall be included in the gross income. Note: interests do not form part of the indemnity but are earnings or income from the use of capital. Example, the insurance proceeds which were not taken, which are taxable. Who may be the recipient of life insurance proceeds? The designation of the beneficiary is not essential for purposes of exclusion of life insurance proceeds from the gross income of the recipient. The concept of revocability or irrevocability of designation of the beneficiary is material only in determining whether the insurance proceeds are to form part of the gross estate of the decedent or not. What are the instances where life insurance proceeds are not excluded from the gross income of the recipient? In the following instances, the proceeds from life insurance policies shall form part of the gross income of the recipient. 1. Where the life insurance policy is used to secure money obligation. 2. Where the life insurance policy was transferred for a valuable consideration. Note: only the actual value of such consideration and the amount of the premiums and other sums subsequently paid by the transferee shall be tax exempt. 3. The recipient of the insurance proceeds is a business partner of the deceased, and the insurance was taken to compensate the partner beneficiary for any loss in income that may result as the death of the insured partner. 4. The recipient of the insurance proceeds is the partnership in which the insured is a partner, and the insurance was taken to compensate the partnership for any loss in income that may result from the dissolution of the partnership caused by the death of the insured partner. And 5th, the recipient of the life insurance proceeds is a corporation in which the insured was an employee or officer. What are the conditions for the amounts received by the insured as return of premiums to be excluded from gross income? The conditions for exclusion are the following. 1. The amounts are received as a return of premiums paid by insured. 2. They were under a life insurance, endowment, or annuity contracts, and 3. They were received either during the term or at the maturity of the term mentioned in the contract or upon surrender of the contract. What is the reason for the exclusion of the return of premiums paid from gross income? The amounts returned are not income but return of capital. They represent earnings which were previously taxed. Define endowment. In endowment, the insurer agrees to pay a sum certain to the insured if he outlives a designated period. If he dies before that date, the proceeds are to be paid to the designated beneficiary. What is the tax treatment of proceeds received under endowment policies? It depends. If the insured dies and the beneficiary receives the life insurance proceeds, these are not taxable income because they are excluded from gross income of the recipient. If the insured does not die and survives the designated period, the amount pertaining to the premiums he paid are excluded his gross income, but the excess shall be considered part of his gross income. What gratuitous transfers are excluded from gross income? The value of property acquired by gift, bequest, or devise is excluded from gross income. The income from said property, however, is included as part of gross income and is subject to tax. Note: only donated property is excluded from gross income. Income derived from such donated property are included as part of a gross income and not excluded. What is the reason for the exclusion of gratuities from gross income? The consideration is based on pure liberality and is already subject to the owner's tax, or estate tax, bequest, or devise, as the case may be. Moreover, there is no income. When is a gift, bequest, devise, or descent excluded from gross income? When a person gives a thing or right to another, and it is not a legally demandable obligation, then it is treated as a gift and excluded from gross income. However, if there is a legally demandable obligation to give, such as for services rendered by one to the donor or due to his merits, the amount received is taxable income to the recipient. What kinds of compensation for injuries or sickness are excluded from gross income? The following compensation for injuries or sickness is excluded from gross income. 1. Amounts received through accident or health insurance or Workmen's Compensation Act as compensation for personal injuries or sickness. And 2. Amounts of any damages received, whether by suit or agreement on account of such injuries or sickness. What kind of damages arising from personal injuries and sickness are excluded from gross income? Damages arising from personal injuries and sickness that may be excluded from gross income are actual or compensatory damages. This is the adequate compensation for pecuniary loss suffered as may be duly proved. 2. Moral, nominal, temporary, or moderate, and liquidated damages should be on account of physical injuries or sickness. Note: punitive or exemplary damages are taxable within the broad concept of gross income. The personal injury exclusion does not apply because the amounts are awarded on account of the defendant's conduct rather than the plaintiff's personal injury. What is the tax treatment for compensation for lost profits? It is not excluded from gross income. Such damages are merely replacements of income which have been subjected to tax if earned. They do not form within the purview of return of capital. What is a tax treaty? A tax treaty is an agreement entered into between sovereign states for purposes of eliminating double taxation on income and capital, preventing fiscal evasion, promoting mutual trade and investment, and according fair and equitable tax treatment to foreign residents or nationals. Air Canada versus Commissioner of Internal Revenue. Example of tax treaty: the Double Taxation Convention DTCs or Double Taxation Agreement DTA, negotiated between the Philippines and the other contracting states or jurisdictions for the avoidance of double taxation and preventing of fiscal evasion with respect to taxes on income. RR number 10, 2010, Section 1, letter F. What is the reason for exclusion? Public policy recognizes the principles of reciprocity and comity among nations. Note: tax treaties are entered into to reconcile the national fiscal legislations of the contracting parties and in turn help the taxpayer avoid simultaneous taxations in two different jurisdictions. CIR versus SC Johnson and Son further clarifies that tax conventions are drafted with a view toward the elimination of international juridical double taxation, which is defined as the imposition of comparable taxes in two or more states on the same taxpayer in respect of the same subject matter and for identical periods. The apparent rationale for doing away with double taxation is to encourage the free flow of goods and services and the movement of capital, technology, and persons between countries, conditions deemed vital in creating robust and dynamic economies. Foreign investment will only thrive in a fairly predictable and reasonable international investment climate, and the protection against double taxation is crucial in creating such a climate. Deutsche Bank AG Manila Branch versus Commissioner of Internal Revenue, GR 188550, 2013. What are the retirement benefits, pensions, gratuities, etc. that are excluded from gross income? The following are excluded from gross income. 1. Retirement benefits received under RA 4917. Retirement benefits received under RA 7641. Terminal leave benefits. 4. Separation paid due to death, sickness, or other disability, or any other cause beyond the control of the employee or the official. Example: retrenchment. 5. Foreign Social Security, retirement gratuities, pensions, etc. 6. Benefits due to residents under laws of the United States administered by the United States Veterans Administration. 7. SSS benefits received in accordance with RA 8282. And 8. GSIS benefits received under RA 8291. NIRC Section 32, letter B, number 7. What are the conditions for excluding retirement benefits under RA 4917, an act providing that retirement benefits of employee of private firms shall be subject to attachment, levy, execution, or any tax whatsoever from gross income? The following conditions for exclusion. 1. Retiree is employed by the same employer for at least 10 years. 2. Retiree is at least 50 years old. 3. Retiree avails of the benefit only once. 4. Benefits are given under a BAR-approved private benefit plan. Note, it does not matter whether the retirement is voluntary, as long as the requirements are met. The retirement proceeds are excluded from gross income. However, if the retirement is compulsory, there is no need to comply with the above requirements before the retirement benefits would be excluded, because the same would be excluded as separation pay, beyond the control of the employee. The rule that retirement benefit may be availed of only once applies only to retirement benefit from a subsequent private employer, and not to a subsequent public employer, as the benefits are still exempt under RA 8291. What is a reasonable private benefit plan? It means a pension, gratuity, stock bonus, or profit-sharing plan maintained by an employer for the benefit of some or all his officials or employees, wherein contributions are made by such employer for the official or employees, or both, for the purpose of distributing the earnings and principal of the funds thus accumulated, any part of which shall not be used or diverted to any purpose other than for the exclusive benefit of the said officials and employees. Discuss the rules on retirement pay for qualified employees under RA 7641. The following are the rules on retirement pay for qualified employees. Where the retirement plan is established in the CBA or other applicable employment contract, any employee may be retired upon reaching the retirement age established in the CBA or other applicable employment contract. Number 2. In the absence of a retirement plan or agreement providing for retirement benefits of employees in the establishment, any employee may be retired under the following. A. Optional retirement. The conditions are an employee upon reaching the age of 60 years or more, who has served at least 5 years in the said establishment, and may retire and shall be entitled to retirement pay equivalent to 1/2 month salary for every year of service, a fraction of at least 6 months being considered as 1 whole year. B. Mandatory retirement. The conditions are an employee upon reaching the age of beyond 65 years, which is the compulsory retirement age, who has served at least 5 years in the said establishment and may retire and shall be entitled to retirement pay equivalent to 1/2 month salary for every year of service, a fraction of at least 6 months being considered as 1 whole year. What is a terminal leave benefit? It is the commutation or monetization of an employee's accumulated unused vacation leave (VL) and sick leave (SL) received by a retired, or separated employee. What is the tax treatment of terminal leave benefits granted to employees of the government? Section 1 of EO 291, Monetization of Leave Credits of Government Officials and Employees, provides that the monetized leave credits of government officials and employees shall be exempt from income tax. What is the tax treatment of terminal leave benefits granted to retiring official or employee from the private sector? It depends. In case of 1. Optional retirement, SL is taxable. VL up to 10 days is exempt. Excess is taxable. Compulsory retirement, exempt. What are the conditions in order that separation pay may be excluded from gross income? The conditions are the following. Amount is received by an official employee or by his heirs. It was received from the employer, and it was received as a consequence of separation of such official or employee from the service of the employer, because of death, sickness, or other physical disability, or for any cause beyond the control of such official or employee. Note, the phrase any cause beyond the control of such official employee connotes involuntariness on the part of the official or employee. The separation from the service of the official or employee must not be asked or initiated by him. What are the conditions for excluding foreign security, retirement gratuities, pensions, etc. from gross income? The conditions are the following. Benefits received are Social Security benefits, retirement gratuities, pensions, and other similar benefits. 2. They are received by citizens and aliens who come to reside permanently in the Philippines. And 3. They are received from foreign government agencies and other institutions, private or public. What are the conditions for excluding USVA benefits from gross income? The benefits must be payments of benefits due or to become due. Number 2, to any person residing in the Philippines. And number 3, under the laws of the United States administered by the U.S. Veterans Administration. Is the income derived by the government or its political subdivisions excluded from gross income? Yes. Income derived from the national government and local government units are excluded from gross income, provided the income is derived from any public utility or from the exercise of any essential governmental functions. Section 32, paragraph B, number 7. Note, the Constitution does not contain any provision granting tax exemption to the government. Obviously, the reason for this is that the government's exemption from taxes is an inherent limitation on the state taxing power, notwithstanding the immunity of the government from taxes. It is also a well-recognized principle that the government may tax itself. What are the conditions for excluding prizes and awards from gross income? The prizes and awards are 1. Made primarily in recognition of A. Religious, B. Charitable, C. Scientific, D. Educational, E. Artistic, F. Literary, or G. Civic achievement. Number 2. Recipient was selected without any action on his part. And 3. Recipient is not required to render substantial future services. What are the requisites for the exclusion from gross income of prizes and awards in sports competition? The requisites are the following. 1. Prizes and awards were granted to athletes. Number 2. They were granted in local and international sports tournaments and competitions held in the Philippines or abroad. And 3. They must be sanctioned by their national sports association. Section 32, paragraph B. Note, national sports associations are those duly accredited by the Philippine Olympic Committee, RA 7549, an act exempting all prizes and awards gained from local and international sports tournaments and competitions from the payment of income tax and other forms of taxes and for other purposes. Section 2. Discuss the tax implications of prizes and awards in sports competitions under RA 7549. The following are the tax implications. 1. The prizes and awards shall be exempt from income tax. Number 2. The prizes and awards shall be deductible in full from the gross income of the donor. And 3. The donors of such prizes and awards shall be exempt from the payment of donor's tax. Enumerate special laws granting tax exemptions. The following are some special laws granting tax exemptions. RA 7916. Philippine Export Zone Authority, PEZA, registered enterprises are given income tax holidays for 6 or 4 years from the date of start of commercial operation, depending on whether their activities are considered as pioneer or non-pioneer. After enjoying income tax holidays, they are subject to the 5% final tax on their gross income earned in lieu of all national and local taxes. RA 6657, Comprehensive Agrarian Reform Program. Gain arising from the transfer of agricultural property covered under the law shall be exempt from capital gains tax for 10 years. RA 7653, New Central Bank Act. The BSP is exempt from all national, provincial, municipal, and city taxes for 5 years. RA 7279, Urban Development Housing Act of 1992. The NHA is exempt from all fees and charges of any kind, whether local or national, such as income and realty taxes. RA 8502, Jewelry Industry Development Act of 1998. Certain incentives are available to qualified jewelry enterprises. RA 9504, an act amending Section 22, 24, 34, 35, 51, and 79 of the NIRC, compensation income falling within the term statutory minimum wage, SMW, paid to SMW earners shall be exempt from income tax. Defined deductions. Deductions are items or amounts authorized by law to be subtracted from the pertinent items of gross income to arrive at taxable income. Section 34. Note, it is a governing principle in taxation that tax exemptions must be construed in strictissimi juris against the taxpayer and liberally in favor of the taxing authority. And one who claims an exemption must be able to justify the same by the clearest grant of organic or statute law. Since a deduction for income tax purposes partake of the nature of a tax exemption, then it must be also strictly construed. Commissioner of Internal Revenue versus Isabella Couture Corporation. No deductions shall be allowed to individual taxpayers earning compensation income arising from personal services rendered under an employer-employee relationship, and those who opted to be taxed at 8% income tax rate on their income from business or practice of profession. RR number 8-2018, Section 8. What are the general rules to be observed regarding deductions? The general rule are the following. 1. Matching concept for deductibility. Deductions must match the income. Deductions must be paid or incurred in connection with the taxpayer's trade, business, or profession. Note, a taxpayer who is authorized to deduct certain expenses and other allowable deductions for the current year but failed to do so cannot deduct the same for the next year. Number 2. Substantiation rule. Deductions must be supported by adequate receipts or invoices. The taxpayer has the burden of proving entitlement to a claimed deduction or refund. Paper Industries Corporation of the Philippines versus Court of Appeals. Note, substantiation requirements are not applicable to a taxpayer claiming deductions under the optional standard deduction OSD, which is based on the fixed percentage of deductions without regard to any actual expenditure. 3. Subject to limitation. The taxpayer is mandated to deduct amounts only within the limits allowed by law. He could choose to avail only of a lesser amount or even none at all. Commissioner of Internal Revenue versus Phoenix Assurance Corporation. 4. Additional requirement relating to withholding. Any amount paid or payable which is otherwise deductible from or taken into account in computing gross income, or for which depreciation or amortization may be allowed, shall be allowed as deduction only if it is shown that the tax required to be deducted and withheld therefrom has been paid to the BAR. Section 34, paragraph K. Discuss the concept of return of capital, cost of sale, or services in relation to deductions. Income tax is levied by law only on income, which may be gross income or net income. Hence, the amount representing return of capital should be deducted from the proceeds from sale or assets and should not be subject to income tax. Distinguish itemized deductions from optional standard deduction. Itemized deductions are those allowed by the NIRC to be deducted from the gross income before the income is subjected to tax. Section 34. On the other hand, an optional standard deduction OSD is a fixed percentage deduction without regard to any actual expenditure. In lieu of the itemized deduction, it is merely a privilege that may be enjoyed by certain taxpayer. Section 34, letter L. What are the itemized deductions allowed under the NIRC? The following are the itemized deductions under the NIRC. 1. Ordinary and necessary trade, business, or professional expenses. 2. Interest. 3. Taxes. 4. Losses. 5. Bad debts. 6. Depreciation. 7. Depletion of oil and gas wells and mines. 8. charitable and other contributions. 9. Research and development. 10. Pension trust. NIRC as amended by Train Law, Section 34. Note: non-resident aliens and non-resident foreign corporations not engaged in trade or business in the Philippines are not allowed the above deductions because they are taxed on their gross income derived from sources within the Philippines. In absence of an express selection, is a taxpayer considered to have availed of itemized deductions? Yes, these taxpayers shall be considered as having availed of the itemized deductions unless they signify in their income tax return the intention to elect the OSD. Such election of the option, when made in the return, shall be irrevocable for the taxable year for which the return is made. However, taxpayers earning purely compensation income arising from personal services rendered under an employer-employee relationship cannot avail of this itemized deduction as amended by Train Law, Section 34. What are the requisites for deductibility of expenses in general? The requisites for deductibility of expenses are: 1. It must be paid or incurred during the taxable year. 2. It must be substantiated with adequate proof showing amount of the expense being deducted and the direct connection or relation of the expense being deducted to the development, management, operation, and or conduct of trade, business, or profession of the taxpayer. 3. It must be paid or incurred in connection with the conduct of trade or business or the exercise of profession by the taxpayer or attributable to the development, management, or operation of the trade, business, or profession. 4. It must be reasonable, not lavish, extravagant, or excessive under the circumstances. It must be both ordinary and necessary. If subject to withholding taxes, the taxes have been properly withheld and remitted to the BIR. And 7. It must not be contrary to law, public policy, or morals, as amended by Train Law, Section 34.